So I think there's enough of us to take care of the background stuff. I'm sure the rest of the other colleagues will join us in the process. Ladies and gentlemen, good morning. Sorry again for the delayed start. We thought we'd give it a bit of time to allow more people to log in. But nonetheless, thank you for coming through. This is our last lab, day 2. I do hope that yesterday was helpful in bringing to the fore some of the things that relates to this topic, particular to the program social housing. So we're building up today. We go straight into section 5. Graham, is that correct?
Yeah.
And Graham is still our presenter. We have still budgeted the same amount of hours that we did yesterday. So if we're on point, we should be finishing just around 12 o'clock. Might be that we finish a little bit earlier than that, or just slightly later than that, maybe a few minutes later than that. But we'll just see. I am assuming, Graham, that you will still allow people a comfort break at some stage. Would it still be 10:30?
Yeah, I think so.
Okay, please note then, ladies and gents, that we will take a breather, maybe a 10-minute breather around 10:30. But in between, then we will still be allowing you to put or post any questions, comments on the chat line. Thank you very much. I see that compared to the teething problems that we had yesterday, particularly with regard to people keeping on mute or not keeping on mute, today we are better off. So can I just plead that we keep it that way, because we also have to safeguard or at least ensure that we don't mess up the quality of this call. I have nothing else to announce at this point. I think right at the end, please don't log out until I have we are done, because I think there's quite critical information that we want to share with you after the delivery of today's content. I think for us it's quite critical that this is not just an academic exercise where we've come in and we've dished all sorts of information, but we leave it at that. There are, as I indicated yesterday, a number of, for example, process owners within the SHRA who may be able to assist you in taking forward some of the things or discussions that came through the last two days. So stick around because as part of our session closing, we will be giving out more details around that and more. Graham, if you are ready, I therefore this point then want to hand over the session to you, sir. Thank you.
Just got to put my blanket on, John. You can see that.
I can definitely see you.
All right. So, morning, everybody. If you were present yesterday, you'll know that we stopped at section 5. So we did sections 1, 2, 3, and 4 yesterday, and then today we're going to do 5, 6, 7, and 8. Also, as I indicated to you, what I want to do is some of the stuff we can go through a little bit more quickly, and then I want to really focus on the benchmarks that that SHRA looks at, and just talk about things like the frequency of reporting as a social housing institution. What are SHRA's expectations of you? And really try and spend a little bit of time on that, because I think that that's obviously going to be of most value for you. So I hope that you attended yesterday so that you don't have a gap in your knowledge. John, are you still there?
I am here, Graham.
All right, I've just sent you the updated presentation. I updated the course outline in the front. I deleted the one on property management. Okay, so I don't know if you've got it yet. Anyway, right.
Sorry, I'm not sure. My network was just acting up here. Was it something that you wanted from my side?
What I was saying is, so yesterday, I had, remember the course outline in the front was, it had stuff on property management. So I've updated this now.
Oh, okay.
All right, and I've just sent you the updated. So it's just this that has changed, because it had the property management one had snuck into the presentation.
Okay. No, then I'll use that and perhaps send that
So
updated
version. Send that with anything else that you want to send to the delegates.
Cool.
All right, so on to section 5. So here we're going to talk about accounting, and what we're going to see is the different financial statements that we have. But to start off with, let's go there. So we've got certain objectives, okay, with accounting: control, accountability, internal and external reporting, information and financial viability. So let's start with control, and I'm going to just put that on presentation mode, make that a bit bigger for you. So when we talk about control, obviously when it comes to things like finances, we can't just have willy-nilly control of finances, or we can't just have no bookkeeping or reporting of finances. So you need to have a good system that's able to reflect fairly the financial position of the entity or of the organization. What financial statements also do is create a level of accountability, because things that have happened are recorded. The institution then becomes accountable, and ultimately, obviously, the board of directors or the board members are going to take responsibility for the overall financial status of the social housing institution. Thirdly, our financial statements are going to be used for internal and external reporting. So we're going to obviously look at the statements internally and see where we stand financially as internal stakeholders, but we've also got a whole lot of external stakeholders. So these would be entities potentially like SARS, although obviously as non-profit organizations, there are certain exemptions that one would get. Of course, SHRA would be a very important external partner that you would need to report to. And SHRA is going to want to see what the financial position is of the particular institution. And then obviously what we're going to be able to see from the financial statements is information about the financial viability of the organization, and to determine whether or not the organization is actually financially viable. And if not, so then what action do we need to take? And if is, then obviously we're a going concern and we can carry on operating. So we're going to get three main financial statements. We've got the balance sheet, which today is known as the statement of financial position. Just people generally refer to balance sheets, much easier to understand. I actually don't like the new terminology. I far prefer balance sheet. Same thing with the income statement or income and expenditure statement. So today known as the statement of income or statement of comprehensive income, and the cash flow statement, or today what we call the statement of cash flows. So what are each of these particular financial statements? So the balance sheet or statement of position is going to demonstrate or reflect our financial position as a social housing institution. So it will reflect our financial position as a social housing institution. So what's going to go into the balance sheet is all of our assets and all of our liabilities. So all of our assets and all of our liabilities. So that's our financial position. All of our assets and all of our liabilities. The income statement will have income, all our income. It will have all of our expenditure. And then it will indicate whether we have a net surplus or a deficit. Okay, remember, based on our discussion yesterday, so we were saying that this isn't a profit-making entity in the true sense of the word, because you would, operate as a public benefit organization under the old Companies Act. This was what was called a Section 21 company. So today we talk about public benefit organizations, and you're going to be demonstrating whether or not you have a surplus or a deficit. So if income is greater than expenditure, then you have a surplus, and if income is less than expenditure, obviously you have a deficit. And the third one is the cash flow statement. Now the cash flow statement is going to show actual money in and actual money out. So it's actual cash that has flowed in and actual cash that has flowed out. The reason why we do that is because the income statement and balance sheet is put together using what we call the accrual concept or the matching concept, right? Or the accrual principle or the matching principle. And what this means is that we match all of our incomes and expenditures to the period in which earned or incurred, even if not yet received or paid. So, ladies and gents, a simple example would be rentals that we account for, but that have not yet been received. So rentals that we account for, but have not yet been received. That would go into the income statement. In other words, rentals that we account for, so a tenant is going to pay 12 months of rent, we would account for that in our income statement, but we might not have received all 12 months because we, for example, might have tenants who are in arrears. So that's where the cash flow statement becomes very important, because the cash flow statement is going to demonstrate actual cash in and actual cash out. So here you can see a basic outline of a balance sheet for a social housing institution. Those of you that understand accounting, so you'll see that there's one question that you may have in terms of what I've put in there, but I'll explain to you why I've done it like that. You can see that, first of all, it's quarterly. So April to June, July to September, and so on that goes. The top half of our balance sheet, so this part here, these are all of our assets. Okay, so these are all of our assets. So you can see that we've got fixed assets, or what we call non-current assets today. So that would in essence be our property stock. So that might be land that we're sitting with, as opposed to, you can see point C is housing stock. And also in our fixed assets, we might have things like our furniture and equipment, potentially, any computers, those type of things would be part of our fixed assets or our other fixed assets. So, however, the financial manager or the financial director or the auditor may instruct you to actually account for your fixed assets. So these are obviously very important from the social housing institution's perspective, because that in essence is what you are renting out, so particularly your housing stock. So you can see that that's B, C, and D, which equals A. Okay, so our assets, current assets, so we've got debtors. So debtors are people who owe us money, and hopefully from the social housing institution's perspective, we don't have lots of debtors, because it means then we've got tenants who haven't paid us, and obviously that's not good. Okay, so we wouldn't want that. You can see we've also got our bank account or cash. And what I've also done is I've put current liabilities here. Now, obviously, current liabilities are not a current asset because they're called current liabilities. But the reason why I've done that is in order to show what we call net current assets. So net current assets is our current assets. So you'll see that I've marked as B, less our current liabilities, which I've marked as C. So that's the only reason why I've put current assets there, current liabilities there. Obviously, if you understand accounting, then current liabilities would go under the liabilities section of your income statement, of your balance sheet rather. So as I said, the only reason why I've put it here is just to show what we call net current assets, being current assets minus current liabilities. So, ladies and gents, obviously, if we add all of this up, so that would be A and D. So A is all of our fixed assets here, and D is our net current assets. We'll end up with total assets. Under the liability section, so I'm going to come back to this portion here. So under the liability section, so we might have subsidies. In other words, this would be money that we've received that we haven't yet spent. Grants that we may have as well. We've got long-term loans. So any loan funding that we raise from a bank. And then you can also see that our accumulated funds or surplus. Now remember, the surplus came from the income statement. Okay, so that's what we discussed here. Income minus expenditure. If income is greater than expenditure, then we have a surplus. Okay, if income is obviously less than expenditure, then we have a deficit. So this accumulated surplus or accumulated funds that we have also goes under the liability section, because if we were to wind down and liquidate the social housing institution, then those funds would have to be returned to the people who put those funds in. So you might, for example, have, let's say, donor funding that you've been able to get for your social housing institution, and you would need to return those funds to the donors, which would come out of your accumulated funds or surplus that you're sitting with. So in other words, at some point in time, it's possible that you've got to pay the money back, and that's why it goes under the liability section. So these are all our assets, and these are all of our liabilities. And the reason why it's called a balance sheet is that assets must equal liabilities. So hence they need to balance. Okay, so assets must equal liabilities. Here you can see the income statement. See that's just a little bit cut off on the side here. But what's important is the set out at the top here and what you're doing, okay, with your income statement. And you'll see that we're also comparing what's actually happening with our budget. So you'll see that we've got these first three columns, the current month. So CM stands for current month. So current month budget, current month actual, current month previous year. So let's say we're doing it for June, okay, or July. The year-to-date budget, year-to-date actual, year-to-date previous, and then you can see this is your annual numbers here, your annual budget, okay, your annual forecast. So the difference might be if you've updated your budget, so your forecast, and then annual year. So this would be so actual numbers as well. And what we have in the income statement is all our income, okay, that we have. So we're going to have levies, service charges, rentals, subsidy progress payments, grants and donations, interest earned. So all of our income will go here, and then all of our expenditure. So you can see we've got rates, we've got insurance. You'll obviously see in the workbook, in the learner workbook. So this isn't cut off. Maintenance materials, maintenance staff, then admin staff, salaries, general administration, so like rent, telephone, those kind of things. Your in terms of your housing development, so any contingency allowance, okay, that you've made allowance for, that you've spent, so you might have had cost overruns or certain things might have happened where you've spent more than you've anticipated. It's obviously money out. Vacancy loss and bad debts, so if you've had any bad debts, and you can see that when you take all your income and you subtract your expenditure, so at the bottom you're going to get a surplus or a deficit. So you can see here total expenditure, so third from the bottom, total expenditure, surplus or deficit, okay, that you land up with. And obviously then you will have, so this period surplus, so let's say for June, if you've had a surplus or a deficit, and then you'll carry forward from the previous month. So what happened in May, and you can obviously see a running total, so you can see what has happened. And that's of course what's going on up here, because you've got current month and you've got year to date. Obviously different financial managers or financial directors may want to set this out in a slightly different fashion. So it's just a suggested set out. Then our cash flow statement. So remember that the cash flow statement is actual money in and actual money out. And again, you can see here that we've got our revenue income. So any of our rental charges. So this is actual money in. Remember, the difference between the cash flow statement and the income statement is that the income statement will record the income in that period, but the income statement doesn't show actual money in, so it just records the income. Any interest, any investment income that we might have, any drawdown on a deposit fund that we might have. So it's actual money in, it's actual physical money that we have in, capital grants that we receive from SHRA. So it's actual cash that we have coming in. So you'll see that that's marked as A, total income. Then our expenditure, salary and staff costs, maintenance, insurance, loan interest, service charges. So money out, you'll see that that's marked as B. We can then show a revenue surplus, which will be A minus B. So money in and money out. And then your capital transaction. So the money from SHRA, you can see, is actually shown separately. So down here. So this here, part A, non-housing fixed assets. So that, we're paying for it. So let's say, for example, that we're doing a development. Okay, we're actually paying. So we've got money that's going out. Subsidy progress payments. So that might be, money in. So we've got to obviously know, so is it money in or is it money out? So we need to know which way it's going. Grants and donations, the sale of stock, and any loan finance received. So these would certainly B, C, D, and E would be money that's coming in. So you can see that we marked it as capital receipts. So you wouldn't want to mix money in and money out. We've got capital receipts here, and we've got capital expenditure here. So this is obviously the money that's going out. Our building costs, short-term loan repayments, and long-term loan repayments. So that's obviously money that's going out. And we can then do a subtotal down here of all the money in and all the money out. We can see, based on our operating revenue and operating expenditure and our capital revenue and capital expenditure. So do we land up overall with a surplus or a deficit? So that's something that's important for us to be able to see, because we need to obviously check where, so where are we from a surplus or a deficit perspective. So, ladies and gents, just some guidelines to managing cash flow more effectively. So some ideas for you. The first one, collect money from debtors as quickly as possible. And we spoke about this yesterday. We don't want to find ourselves in a situation where we're not getting our rental collections in. Because rentals are constrained, even a 2 or 3% non-payment rate can have a very significant impact on our portfolio. So you would want to make sure that you're almost getting to 100% on your collection rate. Number 2, centralize payments and streamline procedures for different functional areas such as accounts payable and payroll. Okay, by using alternative payment methods in years gone by. So you would have had instances where some people are paying by check and some people are giving cash. And obviously this can create a whole lot of difficulties. Really what we want to do is we want to make sure that it's all EFT, and we can then trace where the money's coming in from and where money's going out to. Okay. Thirdly, develop close relationships, okay, with your tenants. So obviously you want to have a good relationship with your tenants. You don't want to have a situation where your relationship with your tenants is not good and then they don't want to pay rent. And some of the things that we spoke about yesterday is that if, for example, there's maintenance that needs to be done, then do the maintenance. You don't want to find yourself in a position where people say, well, you haven't fixed something, so therefore I'm not paying the rent. Also, relationships with various other customers and suppliers. And the reason why you would want to do that is to be able to negotiate mutually beneficial payment policies. So you might then, as a result of your relationship, be able to negotiate better payment terms, bigger discounts. So whatever you can do, everything helps. Number 4, consolidate banking relationships. So also what you want to do is you want to negotiate fees with the bank. So bank charges can be very, very high, especially if you've got tenants who are depositing their rental in cash into your social housing institution's bank account. So those fees can become very, very expensive. Okay, develop accurate cash flow forecasting techniques. So you need to develop accurate cash flow forecasting techniques. And this means that you can then go ahead and you can forecast what your cash flow is going to be like. The operative word here, so what's important is accurate. So you need to be accurate. It's pointless over forecasting to make your numbers look better, and then when reality sets in, you then end up with a situation that you've now got no money in the bank. Six, conduct regular reviews of your cash situation. And what's extremely important to do is that you must analyze any variations from your budget. So it's very, very important that you do that. And you want to do that month on month. You don't want to leave it for any length of time, because you have to identify as quickly as possible any problems that may be manifesting themselves. And then you need to ensure appropriate use of current technology. So, for example, internet banking. So my suggestion to you would be that, it's to be highly discouraged to have tenants, for example, bringing cash to your premises to pay the rent. Okay, rather to get them to pay into the bank account, so you can understand what the problems with that could be. Okay, money could go missing, so you could have a hold up on your premises. You might have staff, okay, that potentially are stealing money. And so obviously you don't want to find yourself in that particular position. And so that's obviously why internet banking is important. Related to that, you've obviously got banks like Capitec today that offer very low cost bank accounts, more so than the other commercial banks. All right, and then, ladies and gents, we also need to talk a little bit about working capital management. So when we talk about working capital, so what are we referring to here? So working capital is going to be so all of our current assets and all of our current liabilities. So here with current assets, what we would be talking about specifically would be our debtors, so the people who owe us money, and of course that's primarily going to be our tenants who owe us money for rent, and then of course our bank account, and then current liabilities. So this would be everything that we are paying, and I'm going to call that creditors. So here what we're talking about is that we've got to manage obviously the cash that's coming in from our debtors plus what's in our bank account, and then we've got to manage what's going out. So what are we paying our creditors? Now obviously there's certain things that we cannot mess around with. So as far as your creditors are concerned, you have to pay your loan repayments every month, because if you default on a loan repayment, it's going to cause some very serious difficulty for the social housing institution. So you need to make sure that you are servicing your bank debt every month and it's paid regularly. And obviously the bank's going to want that primarily on a debit order. So the bank's not going to wait for you to pay. It needs to be paid like clockwork. But some of your other creditors, you can maybe negotiate terms with them. So instead of paying 30 days, maybe what you can do is you can pay 60 days. So of course, your creditors like the bank and the municipality have to be paid regularly. So you've got to pay the city council for rates and taxes, for service charges, and so on and so on. So that you can't afford to mess around with. And there are ratios that we use in order to measure this. So you'll see that we have the current ratio. This represents the relationship between current assets and current liabilities. So what we do is we say current assets divided by current liabilities. So we take all our current assets and we divide them by our current liabilities. And ladies and gents, this is going to give you a ratio. So the textbooks will tell you that your ratio should be at least equal to 2 to 1. You'll see I've put it into the learner manual as well. In other words, for every rand of current liabilities, we should have 2 rand of current assets. The thinking there is that you must have sufficient money in current assets to be able to pay your current liabilities. And then we also have what's called the quick ratio or asset test ratio. And the difference between the two is that, let's try that again. So it's current assets minus stock divided by current liabilities. So current assets minus stock divided by current liabilities. It's really not a major issue for a social housing institution, because social housing institutions as a whole, and let's change the color here for you. So social housing institutions as a whole don't carry stock. So stock, we're not talking about housing stock. Stock would be things that you sell. So like a supermarket, for example, they would have a whole lot of stock. So the reason why we do an asset test ratio is because some businesses have got a very solid current ratio because of the amount of stock that they sit with. So any business that has stock, the concern would be that you must be able to sell your stock. Okay, so your stock has to be saleable. So you've got to be able to sell it. So the asset test ratio, we take our current assets, we subtract our stock to take the stock out, and then we divide by our current liabilities. And the textbooks again will tell you that this should be no less than 1 to 1. The idea being that for every rand of current liabilities, we must have at least 1 rand of current assets, excluding stock. But as I've just explained, for a social housing institution, so it's not something that's going to be a really important one to calculate. It's more this one here. So the current ratio would be important for you to be aware of. Okay, bad debts. Obviously, this is something you want to avoid as best as possible. And just some ideas as to how you can minimize the occurrence of bad debts is do proper reference and credit checks on potential tenants. So you want to just make sure that the tenants that you are getting to occupy your housing stock come with a good track record. Together with that, you can look at payment patterns. So you would do that as part of your credit check, and you would see whether or not the person is actually paying regularly. And then another option is collecting your debts through factoring. So what do we mean by factoring? So when we talk about factoring, so this means that if you've got a debtor's book, you sell that debtor's book to somebody who's prepared to buy it. So you find that the financial institutions have got parts of the bank that do this. And what you would do is you would sell that book. So if you're in need of cash flow, you might, for example, let's say, have debtors of R1 million and you need the cash flow. You would then go and sell that debtor's book to an organization that will buy it. Only thing you need to be aware of is that it can be very, very costly. So sometimes you'll find that these organizations that will factor the book for you, so that's how we say it, you would factor the book, they're going to charge you large amounts of money. So you could be paying 30-40% on your book. So instead of this 600,000, sorry, this million, you're going to get 600,000 back. And also, very often what these companies do is they will buy the book with what's called recourse. Okay, so they'll buy it with recourse. So that means if they can't collect this million and they've paid you 600,000, so let's say, for example, that they can only collect 800,000 and they've given you 60%, 600,000 of a million is 60%. So 600,000, sorry, 60% of 800,000 is 480,000. So the difference between the two, you can see, is 320,000. So obviously the financial institution has lost money, and so what's going to happen is that they're going to want to recover that money from you. So that's what we mean by with recourse. So this is, unless you really have to, is not a suggested way of raising cash, because it's very, very expensive to do this. And as I say, you can see in this case 40% is what's being charged. So you really, really only want to do that if you only have to. We would rather stay away from it. It's much better to make sure that you've got tenants that you've checked out who are going to pay. And so as far as your finance team is concerned, so really, what do we want to do? We want to make sure that we have a good team. They all understand their responsibilities clearly. You need checks and balances in place. That's important because you want to make sure that not one person has full control over the financial function. You want to separate duties between people. You want to separate operations from accounting. This is very important. Okay, because if you don't do that, okay, this is often where you have fraudulent activity taking place. Okay, if you're not separating operations from accounting. What you might then have is people in operations and people in accounting that now are in cahoots with one another. And as I said, this is where you have fraudulent activity taking place. You need to put good security systems in place that we're talking about insofar as things like your banking software is concerned, your accounting software is concerned. Nobody must be able to get into it or hack into it or be able to commit fraudulent activity. That's why to manage all of this electronically is so much better. It really is, where you would make sure that invoices are issued electronically, so or rent statements are issued electronically. It goes out to the tenant electronically, and all payments are made electronically. All money in paid electronically, all money out paid electronically, so that you've got full control over what's going on. And then to keep it simple, so one doesn't need fancy systems for a smaller social housing institution, but obviously as you build your stock, so then you might want to put more complex systems in place. All right, so John, I think what I'm going to do is I'm going to deal with section 6 as well on funding, and then we can stop there before we have a tea break for any questions that people may have. Okay, so guys, let's talk about the important issue of funding. Okay, so as far as your funding plan is concerned, so there's some things that are important here. So first of all, your budget, because if you're going to the bank and you're going to apply for funding for a project, then the bank is going to want to see, so what does your budget look like? Okay, we want to see, okay, what forecasting you are doing. We want to see how accurate, okay, we think you are. Your risk management strategy is also going to be important, so the bank's going to want to see that as well. Okay, your fundraiser should be a dynamic person who can represent the interests of the institution. So you need somebody. This could be maybe the chairman of the board, it might be the CEO, it might be your financial director, who can interact with a banking institution. They're able to speak the right language, okay, with the financial institution. So normally they would have a sound financial background so that they can interact by speaking the same language. And you can see that I've said to you, normally the financial manager or financial director, CEO or MD, okay, is responsible for raising funding. So four key financial questions of the funding plan. Okay, so your funding plan will normally be linked to your development budget, because obviously you would be looking at developing stock, so you would need a funding plan for your stock. And so you would need to be able to answer the following questions. This is what the bank is going to ask you. So number one, what funding do you require and for what purpose? Okay, from where will you access your necessary funding? So this is all over, okay, that we're talking about. Okay, so from where are you going to access your funding? So not only your loan funding, but also your equity funding. When will you need that funding? Sorry, guys, just give me one moment. I just need to blow my nose.
Okay, while we wait for Graham to come back, I hope everyone is still okay. It might be a bit of info to take all in and digest. I see there are a few questions of general nature on the chat line, and maybe I might just use the time to respond to those. So others are asking if the presentation will be shared. Yes. We will be sending you more than just this presentation, but a number of other handouts as well. We've made note of an updated material or learner guide, which we sent you. We need to just send you an updated one. I think the one we sent you last week already didn't have page numbers on it. So we've updated that, corrected that error. So we'll send you that, including this particular PowerPoint presentation. And I think even from yesterday, Graham kept on referring to the Social Housing Act and the social housing regulations. So it is part of the list of documents that we will share with with yourselves, ladies and gentlemen. So I'm just going through the chat line to see if there's anything else. Thank you. So I'm assuming that your comment is still about the presentation, whether it will cover both day 1 and day 2. So that's my reading of your comment or question on the chat line. Okay, Ntombi, definitely will add your contacts, and we will do one mail shot with the details. So for those of you who were not with us yesterday, yeah, these are the things that I've picked up that some of you have not received the manual for some reason. So we'll do one mail shot where all other handouts, including this PowerPoint presentation, will be shared with you. Last 30 minutes with Graham, and we'll be opening up for questions and answers on this last 2 sections. Graham, are you good?
Yes, all good.
Proceed.
Thank you. Just
Awesome.
comes to winter, I can't breathe, and then so when I'm teaching and doing a lot of talking, so it's not so easy for me. All right, so guys, thank you. So as I was saying, so what funding do you require and for what purpose? Where will you access your funding? So it's not just your loan funding. It's going to be all of your funding. When will you need that funding? So that's point number 3. And how much funding will you need to get at each point and from each particular funder? Because obviously you may have more than one, more than one fund. You've obviously got more than one source of funds. So be prepared to be able to answer these 4 key questions that we've highlighted for you here. And so just in terms of the type of funding that you may possibly be looking for, let's just try and maybe make that a little bit bigger for you. So there we go. So the type of funding that you may very well be looking for. So to start off with, you might want to look at what we call bridging finance. And the reason for that is that this is finance that's available for short-term purposes. Okay, so finance that's available for short-term purposes. In other words, you don't want to get into a lengthy relationship with a funder. So you need a certain amount of funding for a short period of time. And what the funder is going to want to see is that you do have your own equity. In other words, the funder is not putting all of the money in, and that's why it's called bridging finance. Because you've got a short gap. Okay? You've got a small gap, so hence you need to bridge that gap. And what obviously we need to understand as well is what grants and in progress payments we might be getting from SHRA through the capital grant. Of course, we might need more longer term funding. So you'll see that here. And then certainly what the longer term financiers are going to want to see is that you're putting in your own money. So there's an equity contribution, and obviously the capital grant goes a long way to helping you with this equity contribution. And what you would have is obviously the long-term finance in place and the capital grant from SHRA. Of course, what's going to be most important is that you can demonstrate that you have sufficient income to be able to service the debt. Okay, there's no funder that's going to be happy to give you loan funding when you're not able to demonstrate your ability to be able to pay the debt back. So as far as your funding proposal is concerned, what is going to go into your funding proposal? So when you approach the bank, what is it that you need to put into your funding proposal? And obviously each bank may have their own, their own particular requirements, but in general, what you're going to have to put into your financing proposal is the following. So what is it that you're looking to achieve? So you would need to give an overview of the project. So what is it that you're looking to achieve? The costs involved. So this is where a professional becomes very, very important, like a quantity surveyor, to be able to break down those costs for you. Okay, what returns are you planning on generating? So the income that you're going to get, and this will obviously indicate that you can at least service the interest on the debt, because sometimes you can negotiate for a period of time what's called an interest-only loan. And I'll talk a little bit about the loan types just when I'm finished going through the funding proposal, the time scale or period, how long do you need the funding for? So what are the benefits going to be of obtaining this funding? Is it going to be enough? Okay, in other words, the bank also wants to know that by giving you the loan funding, are you going to have enough money? Or are you still going to have additional shortfalls, and now you're going elsewhere to go and look for those shortfalls, and can repayment be made? And what the bank's also going to want to see is your income statement, your cash flow statement, and your balance sheet. So with regards to the type of loans that are available, so in general, so the first one is what we call a fully amortizing loan. Yeah, so fully amortizing loan. This means that the repayment that you make includes capital and interest. So if it's a 10-year loan, it means by the end of year 10, everything is fully paid for. So it's fully amortizing. Okay, number 2 is an interest-only loan. So that means that what you'll do is you'll service the interest. So you're going to service the interest. But at some point, you obviously have to pay capital back. Now, especially with a new development, so this is very often quite a useful type of loan to have, because what you're doing is you're servicing the interest. You're not paying any capital back initially. So you need to be aware that very often, so this will come with what we call a bullet payment. So that means at certain points you have to make a capital contribution. So if, let's say, it's a 10-year loan that we're talking about, maybe at the end of year 3, okay, you need to make a bullet payment, at the end of year 7, and then obviously at the end of year 10. So you've got these capital contributions that need to be made. And then there are also ways of structuring the loan during the development phase. So this would be to give you some cash flow breathing space. And the most common way of doing this is what we call an interest roll-up. So that means during the development phase, you don't even service the interest. Okay, it just capitalizes into the loan. Now, of course, bear in mind it's going to have to be repaid at some point in time. Okay, you're not getting it for free. Okay, so it's not for nothing. So that would be, as I say, what we call an interest roll-up. So we're just accumulating the interest into the capital. And then to continue with our funding proposal, So the basic structure of your funding proposal, you'll start with an executive summary. So this will just obviously give a very brief overview. So normally, only sort of a paragraph. Background. So this would be a background to the company, to the social housing institution, all the people who are involved, and also, a background to the project and what the project is all about. The bank's going to want to see management and governance. So how is the institution managed and what governance structures are in place? The bank obviously wants to make sure that the money is safe. Remember that they're using depositors' money. It's not their own money. It does belong to public depositors, and they obviously need to make sure that the money is not going to be spent on things that it's not supposed to be spent on. The services that the company offers, and obviously this is one of the advantages of a social housing institution that has a track record, is that you can show, well, we've done these 3 projects already, and we already have 120 or 150 units under management. The market or the sector, and banks will also have specialized areas of the bank that understand this, because a normal relationship manager at a bank won't necessarily understand how social housing works. So as I say, the banks usually have a specialist that understands the environment. The method of operation, so how you operate, any public relations issues, if you, for example, have had a rent boycott, it's something really that you should highlight. You don't want the bank to come back to you and say to you, we've done a Google search and we see that on one of your projects you've had a rent boycott for 18 months. So how are you going to be able to pay us back? Marketing the initiative. So how are you going to go about marketing your new development? Your implementation. So how's the project going to be implemented and according to what timetable? Your finance requirements. So what are you asking the bank for? You need to demonstrate that you have the ability to repay, and then the future prospects of the company. And so, guys, why that is important is also you want to build a relationship with your funding partner. So you want to be able to go to that funding partner in future, and you now start to build up a track record, with the funding partner. So just to add on to what I spoke about here, just with the different types of loans for you to be aware of. So some of the loan terms, interest rates, you would want to obviously try and negotiate a reasonable interest rate. If possible, the lower the interest rate, the less the payment you're going to be making. Repayments are calculated on the reducing balance of the loan. So that's where we have a fully amortizing loan. So as time goes by, what happens is that you've paid off more interest and you start to pay off now more capital. Repayment terms to suit your particular circumstances. And again, that's where the loan type becomes very important. The feature to repay the loan early with no penalty. So the banks do sometimes levy a penalty if you want to pay a loan off sooner. Additional lump sum repayments accepted with no penalty. So if you have extra capital, that you can put that extra capital in. Flexibility to make larger repayments than agreed. So if you want to increase the bond payment, and the ability to offset interest every day by keeping excess rands in the loan. So all of the banks now offer this. We generally talk about an access facility. So this is a facility on the bond where you can almost use it like a savings account. You can put money in, you can take money out, you can put money in, you can take money out. And obviously the more money that you put in, the less interest that you are going to be paying. All right, so John, so that takes us to section 7. So I think that's maybe a good place for us to stop to see if there are any questions. If not, then I'll carry on with section 7. So perhaps you want to see if we have any questions that we need to address.
There are certainly several questions on the chat line, Graham.
Okay.
Maybe we should take the first 4 on the chat line, and in fact, that's only 4 that I see. And then we'll then open up a round for introductions. That will then hopefully then take us to our comfort break at 10:30, which is 15 minutes from now. So I think the first one that I see is from Dankiso Musia, and it's of general nature regarding the list of prospective financing houses which have funded SHI. Dankiso, we did speak to this yesterday. So top of my head, really, you do have NHFC as one of the principal or major financier in the sector. CIPC has, I think there are talks. If I'm correct. Mandla mentioned the DBSA, Development Bank of South Africa, has funded a number of or a few of the social housing projects. NEF, National Empowerment Fund, they've financed few of the first projects in the sector, and they have expressed interest to do even more. SA Home Loan, they've financed a few sporadic projects as well. Nedbank, now I'm touching on the commercial ones that are top of my head. And I think Standard Bank has financed one or two. So it's a growing and a moving goalpost in terms of the SHRA working proactively so to engage this both GFIs and commercial funders in terms of seeing how we best partner with them in availing loan financing in the sector. So that's a straightforward one. The second part of your question, I don't know, let me read it. The funding coming from the department, can it be kept in an investment account for the interest to be used for paying the interest on the loan? Graham, I'm gonna ask you to
John,
take
are
that.
you asking me that, or I'm just trying to see. I can't see the question. You want to just pose the question to me again there, John?
Well, he's asking if when you have been given a grant, are you allowed to keep it in the investment account such that the interest generated from there is what you then can use to pay your interest from the loan?
All right. So let me just also address the first part of what you spoke about. The financial institutions that you mentioned, like NHFC, they're obviously specialized funders and they understand the sector. But the commercial banks do look at funding, but obviously what the commercial banks want to see is that the project is viable. And that's something that's of course very important for them. And they want to assess repayability. So are you able to service the loan? The second part or the second question about taking the capital grant and putting it in the bank and earning interest, I think should best be answered by someone at SHRA, because I think that what one of your colleagues from SHRA needs to address is how the capital grant is paid. And that will then, I don't want to step out of turn here and say, yes, sure, fine, take 100 million, put it in the bank and generate interest. So I'd maybe like to ask one of your colleagues to address that.
Let me just say that I might respond to that, but it's a hearsay kind of an answer that I'm going to volunteer here. So don't quote me to that. I don't see in the team anyone who works with the CCG. The people who you then contract with are the team in the project development and funding unit or department of the SHRA. And I don't see them in the meeting today. So they could perhaps be the people who respond quite well on the thing. But this is what I know or I have heard. So the interest, I've had a few instances where you as the project owner and the grant recipient, therefore, having to make a request. So it is not ordinarily money that you would on your own accord make decisions on. So there's an almost like an application process that I had heard of that you then make to the SHRA, to the PDNF team for use of that interest. I think at discretion of the powers that be, such an interest may or may not be released to yourself as the grant recipient. I know it doesn't fully, you know, with a very clear authority on it, answer your question. Thank you,
No,
sir. But
John,
it is,
John,
it is, it is.
I
Let
think,
me finish,
yeah,
Graham.
okay. Go ahead.
It is what I have picked up in the discussions and the business. What I can suggest though is I will at the end just give out the details of the PDNF team, or at least one of them, if you are urgently needing guidance on this. Other than that, I do want to also make a recommendation that in a month's time we have scheduled a session specific to project packaging, and this is the matter that we can address in full detail. Come through, Graham.
No, so John, what I was going to say is that I would imagine that the way that SHRA would operate is that the grant funding isn't released to the project owner directly. Okay, the grant funding is going to be paid out to the contractors. And what that then means is that the social housing institution wouldn't necessarily have full access to that funding, which they could then take and go and put it in the bank and earn interest on it.
Yeah.
And
Yolanda is the second question. Was it all?
No,
Sorry, did I catch you?
Just add on that.
Oh, Bandla, yes.
Yeah, the CCG, as Graham is saying, it's paid on phases to the contractor.
Yeah.
It's not the whole amount. It's they submit invoices as per the work that is done.
So it's linked to certain milestones. Okay.
And
right, the second.
John, sorry, just to add on to that as well, based on what Mandla's saying, is that the loan funding from the bank will work on the same basis.
Yes.
So the bank is, let's say, for example, you've got a 100 million rand project, and 60 million rand of that comes from the grant funding, from the capital grant, and 30 million you've raised from the bank, and 10 million is your own equity that you're putting in from the social housing institution side. Even that 30 million from the bank is not going to pay the project owner directly. There will be milestones that need to be achieved, and when those milestones are reached, the bank will then certify that the work has in fact been completed according to specification, and then they will pay the contractor directly. The money's not going to flow through the hands of the social housing institution directly.
Okay. Can I take the next question on the chat line? Moving away from that one, I think more related to this last question that we dealt with. Yolanda asks the question, is the interest roll up the same as interest moratorium during the development phase?
So the answer could be yes or no, depending on how you define an interest moratorium. So I think that it's unlikely that the bank's going to give you an interest moratorium. An interest moratorium means that you're not paying. But if the bank defines interest moratorium as not having to pay for a certain period of time, and then you pay after that period of time, then yes, it would be the same thing. But the important thing to, John, who did you say? I think Yolanda asked that question. So Yolanda, the important thing for you to be aware of is even where you do get breathing space on making loan repayments, it's not for free. So even with an interest moratorium, or as I've explained it, an interest roll-up, all that's happening is that it's capitalizing itself into the capital. So at some point you're going to have to pay the cost of that. What it does is it just gives you breathing space during the period of construction, because during the period of construction you've got no money coming in. There's no rental. So it gives you that breathing space, and that's also why, ladies and gents, it's very important that your project is properly managed by professionals that will get this project done on time, because you want to get the thing finished and you want to get your tenants in place so that you can start getting your rental flowing. Because without income, you're going to be in very serious trouble. So yes, you can have a moratorium on your interest payments, on your loan payments, but it's just capitalizing itself into the capital of the loan.
Okay, thanks, Graham. I think you've answered my question. I just wanted to understand whether the interest roll-up is different from, in other words, is there a different structure than the one that you've just explained now?
As I would understand it, it would be the same thing.
Okay, fixed up. Thank you very much.
Yeah.
Right, moving right along, Zed Mnguni, your question is of general nature. We have addressed this, yes, the presentation. Colleagues, please take note. We will be releasing the presentation, the recording, and all other handouts. Mary Mojanaha is asking, if I don't have own contribution, which I suppose it's equity, do I qualify for a loan? That's first part of that question. The second part, I can't make sense of it, but this is how it reads. And does the loan have part of the grant? Mary, you might just want to clarify the latter part of your question if you are able to unmute and just perhaps clarify the question. Mary Mujanaha?
Yes, yes, Johan.
We don't understand the second part of the question. The first part is clear. You're asking if you don't have equity, can I still apply and qualify for loan? But the second part is not clear. Please explain.
If you get the loan from NEF or something, does it come with a part of the grant, or is just the loan?
Okay. Did you get that, Graham?
Yeah. So, John, so what's going to happen is, and I'm just going to draw on here. So if your project is, let's say, 100 million, so some of that, let's say 60 million, this will be your grant funding. Some of this will be loan funding. So let's say up to 90 million. So this is going to be your loan funding. And then some of it would be equity. And so to answer that question directly, the grant and the loan are two separate things. So the capital grant is coming from SHRA, and the loan funding is coming from a loan financier like a bank. So that would be the difference between the two.
Right, that takes care of Mary's question. Oh, thank you very much, Naledi. I keep on saying PIC something else. Hope they're not here to hear me butcher them.
You keep on talking about CIPC, which is the Company and Intellectual Property
No, it's
Commission.
PIC, Public
what
Investment.
You mean is PIC.
Yeah. Thanks, Naledi, for that. The question next on the chat line is from Fumi. Really asking about what is the benefit to the private person who's putting own equity. So I'll read it as he puts it, or she puts it. On funding, I see that government can give a grant and banks can give a loan which they will get an interest. My question is, if a private person puts an equity, what benefit will the private person get? Or what will the motivation for a private person to put money in?
Yeah. So I think that obviously any investor in a project they would be looking for a return. You know, one of the challenges with social housing is the ability to be able to make the projects work from a financial point of view. So you would ideally be looking for an investor as opposed to a financier, because a financier would be like a bank. They're going to charge interest. Okay, that's what they're looking to return to themselves. As I say, as opposed to as an investor, where that investor would be prepared to accept a lower return to start off with, and they're prepared to wait for their returns over a period of time. So that's very often why you find that the institutions that have been able to be successful might, for example, have an affiliation with, let's say, a church grouping or an organization like that that's able to put in the equity contribution, and they're prepared to wait to get their returns over time, because they understand that the social housing environment is aimed at a particular category of tenant that will be occupying those projects.
All right, the last question on the chat line I'm going to sneak in, because there are others I just see that they're of general nature, is a question to the SHRA from Toriso Madonna, who's asking, in case of a rent boycott, how does the SHRA assist the SHI ODA to resolve the matter? Can SHRA-funded project be liquidated? So, Toriso, it's still early days. We last year had a whole sector consultations with a number of sector stakeholders and vested people with vested interest in the sector, such as your financiers. What that has led to is that we are at a stage where we are, putting together a sector-wide response document that would then guide the sector-wide response, and that's a strategy document that then says, in the event that there are things of this nature happening, and other than just, of course, the rent boycott, we also see that some or a few of the projects in the sector have also been invaded. We know of a project in Pietermaritzburg, for example, where a certain political group has just nearly taken occupation, and they've invaded that project. And fairly new project, which still has its obligation towards financiers and so forth. So we're hoping that strategy document will then provide, practical guidance in terms of how best SHI's ODA should respond in the event of such. What we are doing practically or ahead of this, in absence of this strategy document, I've seen a few projects where such things have happened, where we have assisted, for example, with the resources of a social facilitator who goes in and try and work on remedying the relationships between the landlord and the tenant. I know through compliance and accreditation unit as well, there is remedial work that they do with a few of such institutions where there are elements of rent boycott, and therefore the institution not being able to pick up on their financial obligations. I hope that satisfies. The other questions really I'm going to leave out because I see they really are on general stuff. There are 3 hands that I have noted before we go to our break.
Can I maybe just add something quickly just on the rental boycott?
Sure.
So, Teresa, this is why you want to have good relationships with your tenants, because once you get a wide-scale rental boycott in a development, it becomes very difficult to right-size that development. So you want to have a good relationship, okay, with your tenants. That means that you want to have a property that's in good order. Any maintenance issues must be taken care of. Ideally, what you would also want is to have tenant representatives or a tenant committee that's properly functioning, that is not being hijacked for political purposes or something along those lines. And you need to be a landlord that listens to your tenants, especially because of the nature of the sector that you're operating in. So at all costs, you want to avoid a rental boycott. Just also, John, I'm now seeing the questions. So Paul Lubber asked the question, what would be a good interest rate for an SHR project? So Paul, the answer to that would be 0%, would be the best interest rate for a social housing project. Obviously, that's not attainable. So at the very least, what you'd like to try and do is negotiate at least prime. And obviously, anything less than prime, you would be doing exceptionally well. And okay. John, I see there've just been some requests for contact details. I'm happy to put my contact.
Yeah, no, those are general. I think I've repeated myself. We will definitely address those at the end.
Yeah.
The three hands that I noted in this order, please. I saw B Melody. Your hand was up first, so if you can come through, say ma'am, and just ask your question. After B Melody, we'll then take RAEES. I don't know how to. Is it Reese? If you can come next, and then Malibongo, you'll be the third one.
Hi everyone. My question is basically with regards to the funding. I want to find out why, like, if one was to apply for funding, for grant, why would then the ODA be 20%, and then SHI, if you're applying for grant through SHI, it's 30%. Why is the private sector more, and yet the public sector SHI is less? And I think Graham also has covered the question where private sectors obviously would want a return, but I just want to understand that between the private sector and the public sector, why would the two be different? And another question I wanted to ask is related to the type of housing that one will be providing. Will you guys be covering for student accommodations, and how will that go about?
John, you maybe want to just address the issue of student accommodation, because I don't know from a strategy point of view. So what obviously SHRA would find acceptable.
Well, the student accommodation, just like community residential unit CRU program being that program where government is saying, let us refurbish old hostels and get this to be properly functioning rental housing schemes for family units. Those two are the programs that there have been talks of bringing those under the SHRA's mandate. So at this stage, as I understand, because obviously we work hand in hand and we report to our principal, in this case the department, there is work around policy amendment that has to happen around those two programs that I've mentioned, student accommodation and CRU. So at this stage, none of those are funded through the SHRA. I know that as part of the policy reform work that is currently underway, there was a pilot around the student housing or student accommodation where SHRA had to, working with the department, had to assess what the viability and the possibility, feasibility of such. And I think that was one of the input work stream into the policy reform work. So currently, we are not touching student accommodation. There is nothing in the policy that guides us on that, except that, of course, we are also waiting for guidance from the ministry with regard to what are they going to be amending in the policy and what are they going to be funding, if there's ever going to be funding. I would assume that there would be funding for that if that decision is taken to move this under the SHRA. What was the second part? I think there were two. Was it two parts to your question?
John, I think it was about the grant,
Oh.
the percentage of the grant.
Yes,
Yeah.
the second question is the percentage of the grant through ODA and SHI.
Why the difference? Yeah, I'll be the first one to say I don't have a full answer to that, to say why when the program was conceptualized, that a decision such as this one was taken. I'm still not sure. I mean, I can take down your question and perhaps respond with much more clarity at a later stage, if you allow me, Melody.
Not a problem. I'll send you an email right after this session.
Sweet.
Yeah.
And then let's take the second hand, RAES or RAEES.
Sorry, John, I'll take the ODAs and the SHIs, the difference between that.
Okay, assist Temba. Is this a question to Bimaladi, ne?
Yes.
Listening.
That is just a question. I'll take that one afterwards when you are done. Thank you.
Okay. Is RAEES still here?
What's the difference between an ODA and an SHI?
No, that was not the question. The question she's asking is why the distinction in terms of the equity contribution. Temba.
Okay, I can answer that after you are done with this current program.
That's fine, Mr. Temba. I'll send you an email then, and then perhaps you can just respond directly to me.
As long as you have my email address, that will be fine on my side.
Not a problem. Thank you.
Right. So RAEES. RAES, are you there? Can you hear us? Do you want to ask your question, sir or ma'am? No? Yes? No? Okay. Malibongwe, please go through, and the last 10 that I see on the screen is Mkhu Beki Mthembu. Those are the 4 hands that we'll take and then take our comfort break. Malibongwe?
Right. Morning, everyone. Firstly, perhaps I would like to just touch back on the previous question to say that please do include us on the response. Would also like to get an understanding in that regard. So as much as the previous participant said she's going to ask a question and that they would respond to her by email directly, please do include us somehow. We've indicated our contact details. We'd just like to get that understanding as well there. My question then specifically, it's on the issue that you touched on earlier on concerning the grant money being paid to the contractor or the loan itself being paid to the contractor directly. Then my question becomes, what happens in a situation where the SHI achieves savings in the implementation of works itself? Those savings, therefore, then what happens if that's the case? And also, you've got a situation where professional fees must be paid to the architect and to the different disciplines. If money is moving directly from SHRA to the contractor in terms of the grant and the bank to the contractor in terms of the loan, how then does that get handled? I suppose you can already tell I'm contesting in that regard. My understanding is that it goes to the SHI. Hence they are accredited to manage it efficiently, I would think. So please do advise. I'm a bit rather confused in that respect. That's about it. Thank you so much. I'll also include our contact details on the chat line. Thank you.
All right. To the question that B Melody asked, I think for ease of everyone, we'll respond. We'll give a blanket response to everyone on this question, so that it's clear to everyone to say why the equity contribution different, why the ODAs more pressed to contribute this much and SHI is less of. Graham, there was a second part to Malibonga's question.
Yeah, and then also I think, John, when you respond to all of the participants, I think maybe just also just give the participants a clear understanding of SHRA's process, which will answer this question of how the grant funding works, how the monies are paid. So I think that so I would include that in the response as well, so that people are very clear as to how the funds flow.
So when you say the SHRA's process, I'm assuming that you're talking about this is at the point where the CCG has been approved.
Yes.
And between the SHRA and myself as a developer in SHI, how does all right.
Correct. You know, I don't want to put my boots into it, and then obviously it's the wrong information. So that's why I think it's important that you communicate that process of how the funding's released to everybody, so that they're aware and there's no confusion.
Yeah.
Okay. All right, John, you want to just do a quick 5 minutes? People can go and get
well, there was just this last hand. I'm not sure. I see it's gone down. Mkubeki, Mtembu, if you have a question for us.
Oh, okay. Thank you, John. Morning, Graham, and morning to your panel, and morning to the attendees. My question is just is directed at you, Graham. I just need a little bit of unpacking. When you were going through the balance sheet there, and you mentioned something about donor funding, and you highlighted that upon liquidation of the social housing institution, these funds need to be paid back to the donors. So is it all of it, or what is left? So just unpack that a little bit for me. And the second question is around the stock that as an SHI, we do not have stock. But I just want to throw this on you. I think the number of units for the SHI, that is their stock, because they collect rental on that. So individuals are buying that space. So, and then you also get the occupancy rate. So in terms of occupancy rate, you are able to calculate how many times are you turning that one unit and how much revenue are you generating. And maybe just unpack those for me, please. Thank you.
All right. So I think just to answer the first part of your question, there might be many sources of funding that you're able to obtain. So a donor that's obviously going to put funding in might have certain requirements. Those requirements might be that upon liquidation of the institution, that their funding is returned to them, but they might not have any requirements. So they might give the donor funding and it never needs to be paid back. So, what I was saying to you when we were talking about the balance sheet is that in the instance where it does need to be paid back, then obviously that's going to be paid from whatever reserves or surplus you may be sitting with. And then I think the second part of your question, let's wait until we get to the end of the presentation when we look at the benchmarks that SHRA requires reporting on. Yeah, so John, I'm going to leave that until the end. It's the last couple of slides of my presentation.
Sit. So we are on 10 to 11. Fair enough that we should take a 10-minute and come back at 11.
Yeah, so it's 10:47 now.
All right, cool. So let's return, ladies and gents, at 11 and continue with the last hour of this session. Then there are 2 more sections, and we'll also be wrapping up nicely with more details that would assist you in taking things forward. Take your comfort break now. Thanks.
See, there's no audience.
It's there.
Savings bond. Savings bond is a
Hope everyone is back.
Yes, I'm back, John. Thank you.
Great stuff. Graham, don't seem to pick you up on the screen. Are you here? Graham J. So all the hands that I see, I guess these are old hands, and we have addressed those questions, right? Welcome back, everyone. Thanks, Graham is here. I think let's, without much ado, go straight into the remainder of our presentation in this last hour.
All right, so section 7 deals with financial analysis and reporting. I'm going to just go a little bit quicker because I want to get to the reporting templates that SHRA requires from the social housing institution. So, questions before beginning with a detailed financial analysis. Are earmarked or restricted funds properly identified and explained? And so do we know what those funds are going to be used for? Are there definite commitments with those funds? Are financing costs properly identified? Financing costs, are we talking about things like interest? Are management and administration costs properly identified? If there's a trading subsidiary, and in other words, if you have a separate company that's that's also involved in the social housing institutions, has this been properly identified? Do expenditure headings properly describe the activity of the social housing institution? So is it clear that it's a social housing institution we're dealing with? Are income sources identified? Do the accounts show a surplus or a deficit? Is there a reserves policy? So what do you do with your reserves? Are there any outstanding issues such as risk management? So these would be questions that you ask before actually putting your financial statements together and making sure that your financial statements are going to answer those particular questions. So as far as analyzing your financial statements are concerned, the first thing we would do is we would look at profitability. So we need to be aware of a few things. So firstly, not-for-profit organizations, obviously we're not talking about profit. We're talking about surpluses. We're talking about deficits. And the ratios that we use, we would look at cost to income as opposed to costs to profits, as an example. Secondly, some costs are relevant no matter what the nature of the organization is. So obviously things like wages and salaries, doesn't matter whether it's a for-profit or not-for-profit organization, any particular organization will have those costs. So an organization that requires external funding and is obviously heavily dependent on external funding will need to make sure that they assess the costs of that funding. And point number four obviously goes with it, that if you're getting grant funding, so you need to be aware that you might have little or no money to pay for your general running costs. And that's why, ladies and gents, it's important for you to understand that if your thought process is that you're going to use the capital grant from SHRA to fund your institution, and you're going to have to put little money in. So I think you just need to be aware that that's not necessarily going to be the case. So it's important that that you understand that there are challenges around making sure that you have sufficient funding available in order to be able to operate a successful social housing institution. So secondly, we look at liquidity and efficiency. So a key indicator for any social housing institution is going to be cash flow. We know that there can be considerable delays between income coming in. Remember earlier I spoke to you with the income statement, we'll record the income, and in the cash flow statement is the actual money that's coming in. Project funding very often has long lead times, takes us a long time to get the project funding in place. And for SHRs with significant project funding, the amount of the potential project income at any one time is a vital piece of management information. So you'll see the question that we've posed is, how long could the SHR continue to operate on its present cash balances if no further cash comes in? So how long will you be able to operate with no further cash? So you'll see that in terms of a detailed financial analysis, what we're going to want to look at is our funds. So where are we getting our funds from? Are we liquid? So are we able to operate? management and administration costs. So are we able to cover those costs? Our financing costs, so what are they, and are we able to cover them? Resources that we have at our disposal, the performance of our assets, any reserves that we have in place, and the general performance of the social housing institution. And again, okay, you'll see that what I'm going to do at the end at the end of the presentation. So these are all the benchmarks that SHRA applies. So I want to just get us to that particular point so that we can look at those benchmarks. And then our management accounts. So our management accounts, we would generally prepare when we don't have final sets of financial statements available. So a bank, for example, might want to see a set of management accounts, which means that these are not audited financial statements, and the management accounts need to be presented in an acceptable manner. What's in the management accounts must be relevant. So relevant information, it must be accurate, it must be intelligible so people can understand what's in the management accounts. It must describe availability. So in other words, if you're talking about cash resources that are available, so those resources must be available. Your statements must be clear. They must provide context that it's clear for a funder to see what's going on from those financial statements. Must clearly demonstrate ownership, involvement, so who's involved in the social housing institution, who's involved in any particular projects. They need to be transparent, they need to demonstrate accountability, and they also need to be able to be trustworthy. And so these last three issues here really go to issues around governance, things like the requirements of King 4. So King is a retired judge who has created our codes of governance in South Africa, and we've had King 1, King 2, King 3, and we now have King 4. And the King 4 report clearly demonstrates the various principles of accountability from a governance perspective. Section 8, dealing with monitoring performance and auditing. So ultimately at the end of the whole process, so we need to actually check to see that we have delivered according to expectation, that things are in fact accurate, okay, fair, true, reasonable, comply with our governance standards, and so on. So what we're going to be asking is, have we been economical? Have we been efficient? And have we been effective? So do we need fancy offices with chairs that cost 5,000-6,000 Rand each, okay, and fancy desks? Are we actually spending our money in the best way possible? Have we been able to achieve the best result with the resources that we have at our disposal? So these are issues of economy, efficiency, and effectiveness. So we've been economical. So that doesn't mean to say cheap, okay, but we've done the best with the money that we can. That goes together with efficiency. So we've had efficient use of our resources, and we've been effective. Okay, so we've been able to achieve our objectives. And obviously that's something that SHRA is going to be interested in, is that we've actually achieved our objectives that we've set out to achieve. So just some ideas here as far as performance standards are concerned. So let's make that a bit bigger for you. There we go. So you can see our first goal, our SHI will develop 1,200 units over the next 5 years. And so things that we need to ask ourselves as far as this goal is concerned. So the target group. Okay, so you can see that the question here is, does your target group have the characteristics, okay, you mentioned in your mission? So these 1,200 units, okay, that you want to develop, have you identified the correct target group? Are you going to be able to have enough tenants for the stock that you want to develop? That will also go to things like, are you in the correct area, you know, from a location point of view? Do you have access to land in order to be able to do these developments? So this is all going to go to the goal that we have of developing these units over the next 5 years. Goal 2, our SHI will involve future tenants in operations. So have you had meetings with tenants? Okay, so it's important that tenants are involved in the process, because remember, you're providing the stock for them. Our SHI will have appropriate staffing structures in place. So have these posts, okay, been filled? And over time, as you build up stock and you generate more income, so you should be in a position to be able to do that. Our SHI will have finalized the first phase of 300 units by the end of 20XX, so whatever that year might be. So were you able to achieve this? Okay, a tenants committee will be established by the end of phase 1. Okay, so however, so that might be, let's say, 2,000 units. Okay, or it might be a date that we're talking about. Okay, will we appoint a caretaker? Okay, we will appoint a caretaker by the end of October 20XX. So has the caretaker actually been appointed? So indications that things are not going in the right direction. Number 1, an increase in our overdraft or our funding levels. So it's something that we would need to be careful of. Okay, losing clients or customers. Yeah, so tenants are moving out and we've got high levels of vacancy. Losing key staff. Okay, receiving red reminder letters. So that's for overdue accounts. Okay, we don't want to be getting those. Okay, increasing bad debts. Obviously, that's going to be a very big problem. You can see the example that we've given you here. So if the profit on an activity or its contribution to core costs is 10%, and the SHI has a bad debt of 5,000 Rand, it has to earn another 50,000 Rand more in revenue to compensate, because obviously 10% of 50,000 is going to be that 5,000 Rand that we need. Getting phone calls from the bank, so obviously that's not not good. Okay, then cash flow. So what not to do. So this is how to run out of money quickly. Okay, delay sending out your invoices. So you need to get your statements out. Losing documents. Okay, failing to chase up your debtors for payment. Okay, failing to take credit when it's offered by your suppliers. Paying excessively promptly, so paying sooner than you need to. Buying unnecessarily large quantities of supplies in order to get discounts. If you don't need that quantity, then better not to do so. Okay, buying equipment and vehicles for cash. Okay, instead of negotiating credit terms or rentals. Hiring staff who are inadequately trained and can't do the work. Keeping staff on when we've got no prospect of giving them work, and failing to check documents before signing them. Number 11, failure to get a signature if goods are delivered. So you need to make sure that in fact you ordered those goods, that somebody just hasn't ordered them for their own use. trusting a bookkeeper completely. Remember, you have to have checks and balances. So you don't want somebody who is fully in control of the whole finance function. It can be disastrous. Trying to insure against every conceivable problem. Sometimes it's not possible to insure against everything. Not keeping the bank manager informed or your bank informed. Failing to plan in advance for your cash requirements. You need to make sure that you compare your actual performance with your budgets. So this here is what we call variance analysis. So variance analysis, where we compare actual with budget. Not confirming agreements in writing and saying to yourself, oh, it doesn't matter, it's only a few rands. Because when you add up all of those rands, it can come to significant amounts. As far as auditing is concerned, so we've got two things that we need to be aware of, is an internal audit and an external audit. So an internal audit will be done with your own staff. And obviously when you start out, so you'll have very few staff to begin with, but as you go along, the number of staff will increase. And what you're doing is you're checking internally. So one of the committees that you will have as part of your structure of your social housing institution is an audit committee. And the audit committee will obviously be there to have a function of oversight, to make sure that everything is being done according to policy and procedure. So your internal audit will ask questions like, were the goals achieved for a reasonable cost? Was the accounting system efficient and effective? Okay, was the budget an accurate assessment of the strategy's financial implications? And then you'll have an external audit. So these will be independent auditors that will undertake the external audit. And the purpose obviously will be for them to express an interest as to whether or not they believe that the financial statements fairly represent or fairly present the financial position of the social housing institution. So you can see that the phases in the auditing process, and again, not something that you need to be aware of in a huge amount of detail for yourself, because obviously the auditors will take care of this. So phase one is preparation. So you prepare for the audit. Phase two is to identify and categorize risks. So both your internal and your external auditors will do that. Phase three will be to conduct a risk assessment. Okay, so that's part of the reporting that the external auditor is going to do for you. Okay, phase four is to identify your audit priorities. So what you're going to do is actually here you're going to undertake the audit. So that's what all of these steps are about here. And then phase five is to complete your audit. And then what you're going to do is to submit the final audit for approval. So you can see just some of the roles and responsibilities of various role players. So if we start with the audit committee, let's start at the bottom. So the audit committee is responsible for approving the internal audit plan. Senior management, responsible for participating in identifying and assessing risks faced by the social housing institution. Your project team, responsible for proposing and executing an approach for implementing the methodology within the social housing institution. And your project authority, overall responsibility for project management and the production of a quality deliverable on a timely basis. So this here, for example, might be your board of directors. So they take overall responsibility for making sure that the audit is completed on time. Your internal auditors will report to the board. So the internal auditors will obviously highlight any problems. So this will be done before your external audit is completed. So that's why your internal auditor will be doing all of this on a continuous basis to highlight whether or not there are any problems, any challenges, any risks that one needs to be aware of before your external auditors pick it up. And you can see just a project plan again. So this would be from an auditing perspective. So you can see here, review background documents, develop your communications, identify risks, and obviously, as I say, your auditor will be responsible to do all of this. Yeah, so you can see that that's these two slides over here. And you can see that the phases are also mentioned, and the phases refer back to this diagram over here. Okay, initially, what's going to happen is that your your finance director or your financial manager is going to be taking care of a lot of this, because you're not going to have the money to pay all of these fancy salaries, okay, to have all of these people in place. So if we look at our internal audit, so what is it communicating to us? What's the purpose of the internal audit? So it's an independent, objective assurance and consulting activity. So we want our internal auditors to check to see that everything is on track, as I say, before our external auditors really pick up any major issues. So it's a systemic approach. It's systematic, and it's designed to improve the effectiveness of risk management, control, and governance. So your internal auditors will obviously make recommendations as to what needs to be done. Risk management, which is an important part of the auditing process. So here, what are we looking at? So we want to look at all risks that we're exposed to. So with limited resources, our internal audit can focus on the areas of risk that are most important to the organization. Project overview. So when we look at a project, what we need to do is we need to ensure that we identify risks and make sure that we've got an adequate risk management strategy in place. Again, our internal auditor or our financial manager is going to help us with that. And then, of course, the expected benefits is that we want to have a better understanding of risk and risk management. So whether it's a project issue, whether it's somebody having too much control over finances, so whatever those risks may happen to be. And then you can see here's the external audit. So what is the external audit going to do for us? Independent review of the SHI's activities. You want it to be value for money, because auditing can be quite expensive to do. So there's nothing stopping you negotiating rates with your auditor. It's more than just checking figures. Hopefully what your auditor is going to do is to provide innovative ideas, how to improve your effectiveness, your efficiency, your accountability, and give you practical advice. And then the auditor will cover the following key areas. Assessment of risk, analysis of relevant law and regulations. Obviously, the auditor is going to check that you're complying with laws from a financial point of view, Companies Act, things like international financial reporting standards. The auditor is going to have a look at key aspects relating to the SHI's income and assets, see whether there are any matters that need to be reported to the Registrar of Companies. So that's SIP C that John's mentioned a couple of times before, and report on the financial statements. Okay, so this would be obviously a very important checking process. All right, now what I want to focus on, and I want you to see if I can make this just a little bit bigger for us. So these are the reporting templates that SHRA provides. So when you report, this is what you are going to be reporting on. So there's a spreadsheet that SHRA will provide, and this all has to be populated. So let's go through each of these particular issues. So the first category is rent management. So what you're going to be reporting on will be rent collection, vacancy rates, and your debtors balance as a percentage of your monthly revenue. So what's your rent collection like, your vacancy rates, and your debtors balance as a percentage of monthly revenue. Now you can see that what's identified here as well is for an SHI, okay, an MOE, and an ODA. And the various percentages, okay, that are required, you can see they're in essence all the same. Okay, if you look at all of these various percentages. So I'm just going to focus on the SHI column. So your rent collection must be greater than 95%. Now, if you're collecting less than 95% of your rental, that's a problem. Your vacancy rates must be less than 2%. So if you've got 100 units, what SHRA is looking for is no more than 2 units being vacant at any one time. Your debtors balance as a percentage of monthly revenue less than 5%. So obviously that's rental that's outstanding as a percentage of the total rental. Your housing stock management, total operating costs per unit, you can see that this needs to be less than 1,600 a month for a social housing institution. You'll see the red, what's marked in red, would be minimum maximum thresholds before regulatory action. In other words, before SHRA steps in. So you can see that on your rent collection, so you can see that where SHRA is going to be concerned is where your rent collection is under 95%. Okay, your vacancy rate, okay, 5%. Your debtors balance, okay, now it hits the 20% mark. So this is where SHRA is going to be concerned. Okay, so this column over here. Your debt service coverage ratio. Now your debt service coverage ratio, you can see that the best practice is greater than 1.3. What SHRA is looking for is greater than 1.1. Now what your debt service coverage ratio means, how we calculate it, is it's going to be your bond payment relative to your net income. So obviously, which one do we want to be greater than which one? So your net income must be greater than your bond payment. So what we are saying is that if your bond payment is 100 Rand a month and your debt service coverage ratio is 1.3, it means that your net income must be 130 Rand. So 130 over 100 is going to give you 1.3. And you can see that the minimum there is 1.1. Obviously, if you're going to drop below 1, it means that you don't have enough net income to be able to service your debt. Now remember, net income is after expenses. So that's going to be after your operating expenses that we're talking about. So the banks are also going to be very concerned about this ratio. You have to have enough net income to be able to service your bond payment. And this is often where the bank will assist by saying, we'll do an interest-only loan to start off with, because we know that you're not going to have sufficient cash flow. Rent management, your turnover rate. So, you know, your turnover of tenants, and you can see that these are secondary benchmarks. Okay, the primary benchmarks are obviously the most important ones. So these are your secondary benchmarks, your turnover rate. You can see best practice is less than 2%. So if you've got 100 units, ideally you don't want more than 2 tenants moving out and rotating every month. So that's not good. And you know what it does is it puts wear and tear on the building. It causes maintenance issues, people moving in and out and their furniture and knocking walls and so on. You want to try and have stability insofar as your tenants are concerned. Your eviction rate, you can see that best practice is less than 0.5%. Debtors over 30 days, best practice less than 10%. So if your rental collections are 100,000 a month, and we can see that your debtors balance as a percentage of monthly revenue needs to be less than 5%. So of that 100,000, you don't want more than 5,000 outstanding, and you want to be collecting it in as soon as possible. So you can see debtors over 30 days as a percentage of total debtors, debtors over 60 days as a percentage of total debtors, and debtors over 60 days as a percentage of net debtors after provisions. In other words, this is where maybe some of your debtors you have to write off as a bad debt. So really what Shra is saying to you here is that you can't be running outstanding debtors for longer than 60 days. So you need to be collecting your outstanding debtors within 60 days. Annual maintenance cost as a percentage of insured value. So you can see here that your benchmark, okay, there 1.02%. So what that means is that if your insured value of your development is 100 million, then what we're talking about is your maintenance costs of around about R1 million, so around about 1%. Direct cost to income ratio, so your direct costs, so these would be, I just want to see the definition on the next page. If we have a look here, so you can see in this table, it gives you a definition, project operating costs divided by your project revenue. Yeah, so your project operating costs divided by project revenue. So that would be costs at the actual site. So you would have things like, electricity, security, cleaning, maintenance on site. So here we're not talking about a head office cost. So these are project operating costs. Where did we get up to here? Number 12. So Shra wants this less than 50%. Okay, your quick ratio, I mentioned to you earlier, you can see must be greater than 1. So I told you that the benchmark is at least 1 to 1. Your debt to capital ratio, so less than 50%. In other words, debt, so, debt as a percentage of, again, let's look at the definition. So your debt to capital ratio, so debt, your total liabilities as a percentage of your total capital, total liabilities plus total equity, must be less than 50%. Okay, so let's look at that one again. Your total liabilities. Okay, so total liabilities divided by total capital available. So total liabilities plus total equity. So it needs to be less than 50%. Bad debts as a percentage of revenue, under 2%. Solvency ratio divided by your debt asset ratio. So again, let's look at the definition. So total assets minus your debtors over a 30-day period. So total assets minus your debtors divided by your liabilities. Okay, so total assets less your debtors divided by your liabilities. So in other words, you're talking about assets over liabilities. And you can see here that that needs to be greater than 1. In other words, your assets must be greater than your liabilities. Your insolvency ratio, the definition of that, project annual net profit after tax before non-cash items. So your major non-cash item would be depreciation. Okay, so depreciation is a non-cash expense. So depreciation is an expense on the institution's income statement, but you don't pay out depreciation. So that's why we call it a non-cash item. So project annual net profit or net surplus. So the project net surplus before depreciation and interest paid. So this is surplus before depreciation and interest divided by total project liabilities. So your surplus before interest and depreciation divided by your project liabilities. In other words, what we are looking at here is, can the project service its liabilities? And you can see that the ratio here, it must be greater than 9.75%. Units per staff member greater than 45. So again, you can see the ratio here, number of staff divided by the number of units. Indirect expenses as a percentage of revenue, less than 25%. So the definition, indirect staff salaries. Okay, so effectively these are all the people who are working in your head office. So your indirect staff salaries plus your administration costs plus directors' remuneration. So in other words, what we're saying is this is your head office cost. Indirect staff salaries, admin costs, directors' remuneration divided by project revenue. Okay, and that must be less than 25%. So you can work out, you can already see for yourself, if your first project is 30 units, look at the revenue you're going to be generating, and you can see what SHRA is looking at in terms of what benchmark you should be spending on things like staff salaries, admin costs, and directors' remuneration. And then your indicators down the bottom here, your average loan to unit. So you can see here that your average loan to unit, all right, so this one here is left out because you can see it's gone from 19 to 22. So I'm going to talk to you now about your average loan per unit. Share of social housing units in your total portfolio, because obviously some institutions don't have all social housing units. They've got a mix of social housing plus non-social housing units. And then your surpluses and your reserves that you have available. All right, so ladies and gents, I just want to give you some parameters, okay, within which your successful social housing institutions operate. Okay, firstly, some sort of housekeeping issue from SHRA's perspective. This reporting that I've just shown you here, you would report quarterly, and this would be within 15 days of each quarter ending. So you would need to submit this reporting every quarter within 15 days of the quarter ending. What I've done is I've just shown you an extract from the tool. There is a spreadsheet with multiple tabs that SHRA provides you with, and that has to be populated. And obviously SHRA would assist with the population of it. The acceptable benchmarks I've highlighted to you already in terms of what SHRA finds as acceptable limits for your social housing stock or social housing projects. So I want to just share the following points with you, and there are about 9 or 10 of these points as almost sort of key success factors to making your institution viable. One of the things that I've mentioned already is that you need a certain number of units to achieve critical mass, and the figure that I gave you was about 1,000 units. Now you're obviously not going to be able to achieve 1,000 units all at once.
To her phone, then they're going to call me, and I'll ask them to.
Sorry, there's somebody whose background noise is coming through.
Muted, you can continue.
Right, there we go. So this should really be your objective over, let's say, a 3 to 5 year period, because it takes time to build that critical mass. If you are going to just have 40 or 50 units, one development, you're just not going to be able to make it viable because the rentals are governed. So you're not going to be able to have sufficient revenue.
Graham?
Yes.
Sorry, it's John here. I don't seem to see the presentation. I don't know that it's my own.
No. So it's not on a presentation. It's
just so you haven't. Okay.
I'm just making some general comments, John.
Okay, cool.
Okay, so I'm just making some general comments here. All right, so guys, the first thing is that so you need critical mass. Okay, the second thing is that you have to keep your overheads down. Okay, so you've got to keep your overheads down. And you can see that we've looked at some of the ratios that TRA requires. So you cannot have a top-heavy head office cost. You can't have 14 directors all earning fancy salaries with fancy cars and fancy offices, because you're just not going to have the income to be able to service all of those operating costs. Okay, the third thing is, in fact, maybe what I can do here is I can just put some of these points onto a Word document, and I can then project up the Word document. So maybe let's do that. There we go. Right, so here we are. So the first thing that I mentioned was about having critical mass. The second thing, which I've just spoken about, is to keep your staff overheads down. So that's why you're ideally going to want to have somebody who is maybe the CEO, but they also have a finance background, so that they can do both things to start off with. Or you've maybe got somebody who, let's say, has a quantity surveying or a construction background that can, handle the costings, deal with the quantity surveyor, deal with the architect, be on site. So that person needs to really run the whole development side of the business until you build up sufficient mass to be able to employ more people. Choose your board members very carefully. So they need to understand that in the beginning that there may be little or no payment, but over time that payment will obviously happen or occur. One of the things I mentioned to you yesterday was about potentially partnering with the city council, especially in terms of land availability. I see that questions have been asked about land and where you get land. So remember, guys, that part of your challenge is going to be that you ideally not going to want to pay market-related costs for certain things that you might be able to negotiate better prices on. So partnering with the city council would potentially give you access to more reasonably priced land. Related to that is to negotiate your professional fees, typically on an arm's length transaction. Any development you do, not social housing development, but any development that you do, you're looking at usually spending on total development cost between 12 and 14% on professional fees. So if it's 100 million rand development, so 12 to 14 million of that 100 million rand development will be to pay the architect, the quantity surveyor, and so on and so on and so on. Ideally, and I know those of you that come from a professional construction background, so please don't laugh at what I'm going to say to you now. So ideally, what you want to be able to do is to get this down to round about 6%. You want to get your professional fees down. So what you're looking for here is a professional team that's prepared to travel the road with you, and they understand that they're not going to be able to charge normal professional fees. They're charging half of their professional fees. Or you're looking for professionals that have a passion for the social housing environment, and they're prepared to take less in terms of the fees that they charge. And there are those professionals out there. But this is very important to control. You ideally don't want to have a development cost per unit of more than about 450,000 Rand. So when you add up all of your costs and you divide by the number of units, you don't want to be sitting at more than 450,000. Now, when you look at the last 2 points, 7 and 8, so you'll understand why this is the case. Your capital grant is, let's say, 271,000 per unit. You also don't want to go over about 100,000 Rand borrowing cost per unit, because you're not going to have enough income to service your debt. So if you then work that out, if your capital grant takes care of the first 271,000 and you obtain loan funding of 100,000, so that takes you to 371,000 now, and you know that your cap on your development is 450,000. That means the difference between these two here, so you're talking about 80,000 Rand. That is equity that you're going to have to put in per unit. If you've got 100 units and you need to put in 80,000 Rand of equity per unit, so 100 times 80,000, so you're talking about an 8 million Rand contribution, okay, that's required in equity. And obviously, to start off with, there are not many startups that are going to be able to afford, okay, that 8 million. So that's why, guys, this here needs to be roughly your target that you're looking at. That is about 370,000 in terms of your development cost per unit to get started with initially. So that's the reason why it's very, very useful if you have, as one of your board members or one of your staff, somebody who comes from a construction background, okay, who is able to negotiate with contractors, negotiate with professional teams, because you have to keep your costs down. Okay? You really, really have to keep your costs down. Otherwise, you're going to find yourself in a situation where you're just going to have a project that's not going to be able to be feasible. I think John mentioned that there's another session in a month's time about project packaging. So, it's probably suggested that you attend that session on project packaging. And, guys, as I've mentioned to you, that it is a challenging environment because your rentals are governed with regards to what you can charge. And then a lot of your costs are obviously market related. So like professional fees, like land, like construction costs. And that's obviously where you want to be able to cut your costs as best as you can in order to bring your project in as cost effectively as possible. And of course, to understand the rules. So what is it that SHRA requires in a completed unit? If you're talking about granite tops in the kitchen and fancy cupboards and bathrooms with the best finishes, obviously you're not going to be able to provide that product at what we are at the costs that we're talking about. So it's important that you understand what's required from a finish point of view as well. So what finishes are acceptable? So what is it that SHRA requires from a finish perspective? Because that's clearly going to impact on your ability to deliver the product within the parameters that I've just mentioned to you. And as I say, those parameters are really based on on research that I've done with social housing institutions that have been successful. All right, John, we can now move to questions.
Thank you very much, Graham. I'm just looking at the time. I'm going to plead that people lend us your extra 15 minutes. So we're not as yet done. So perhaps for the next 5-10 minutes, let's do Q&A and get it out of the way. And then I will then come back and close the session with a few heads ups in terms of announcements and things that could assist in taking things forward. So for now, let's take questions. I'm gonna prioritize at least 4 questions on the chat line and then 4 hands so that we don't take too much of your time. So the first question is, Graham, it's about the manual, whether this covers are the quick and asset and debt service cover ratios detailed in the training?
Yes, so Yolanda, from what I remember, it is covered in the manual. Yeah, so it is in the manual, and then obviously, if I put my contact details into the chat box. If you wanted any further clarification, you're welcome to contact me.
Fantastic.
Thank you. Sweet. Paul asks, is there possibility to increase on the CCG? I think I might have spoken to this yesterday, but Graham, you have 2 cents to add to that?
Well, look, it would be wonderful if we could get the capital grant increased from 271,000 to 350,000. But I think that's a policy issue which one has to address with the Department of Human Settlements.
Yes. So are we not, I mean, it's still an area of lobbying the department where we're saying it needs to be indexed literally every year to CPI. But currently, it is what it is. So this 271 is what we're allowed. The only time, as I indicated yesterday, that an allocation of CCG would be increased is if you as the project owner or developer, SHI, can prove that other than just stopping at that 30% unit allocation in terms of the primary target market, you go much more deeper than that, say, for example, 32% or even more. I think that's what I've heard, that that's the circumstance in which the SHRAM would consider an increase of the CCG amount that you receive.
Yeah.
Any other question? Hands up those are the two questions that I have received on the chat line since 11 o'clock when we came back. Are there any other questions? We dealt with everyone. Hands? I don't seem to pick up any hands. Mandla, on your side, please assist me. Are there any hands that you can see? Otherwise, I can just as well go to the closing remarks. Mandla?
There's no hand,
Nothing.
John.
Okay, all right. Now then that saves us time. So let me then just do my last piece. Thank you first and foremost to...
Wena uclaima umsebenzi owenziwe through your contractors. Manje wena sekubalekile ama-contractors.
Please mute yourself.
Andre, you need to mute yourself. You subventioning there with your contract.
Hearing everything. We are hearing everything.
Muted.
Yeah. Manda's subventioning with his contractors.
I was on the point of just saying thank you to Graham for really spending a time with us in unpacking these things. It might also feel quite a lot to digest all in one. This is our first. There are further more sessions that we will be running to perhaps even at more greater detail, look at specific areas, for example, project packaging and what is involved and what are the key considerations there. SHI establishment and accreditation, what are the key things there that one needs to digest? So don't lose heart that today, and I mean these last 2 days, we have not really met all your expectations. In fact, I just see that something that I wanted to also indicate, other than just to give thanks to Graham, but and also to say kudos to yourselves as the participants, to just request your evaluation, even a sentence or two on the chat line, if you can just give us your feedback in terms of how has these last 2 days been for you. Has this subject assisted? In fact, I must point out that the last we did this session really on financial was in 2016, 2017. This has been a while. So your feedback really would assist in saying, is this something that is worth repeating in the near future? And what are the things that you say we be good to improve on in terms of this particular offering? So take a minute as I close to just put on the chat line there your comments so that we can bring it in when we do our own internal review of this particular session. The second part, I really want to start it with an apology. Only 3 days ago, I was alerted that the link that we issued out for you all to register your details had an error, or rather did not really allow you to select the sessions or the topics that we have up. So and I just went in and checked with our team from marketing and communication, and they tested the things, and it just confirmed. So in resolving that, this is what is going to happen. Please note that Lesego Diale will be emailing all of you in the next day or two, latest by Monday, the new link, which will then be requested to make that selection. I think all your details we have captured. Is just the selection of the specific topic so that we know who to send which confirmation to regarding the various topics. So that's very important, colleagues, ladies and gentlemen, that look out for the email from Lesego. In fact, let me also volunteer to give you Lesego's email such that if by Monday you have not received by close of business Monday, please write to Lesego d.org.za. In the event that you have not received a communication that says this is the new link that you'll then do your selection from. While I'm still on the contacts, let me also just say that much of or some part of our deliberations for the last 2 days have taken us in great detail on social housing and project-related matters. So I can imagine that this has sparked questions in your mind around these two work streams or these two processes of the SHRA. SHI establishment, SHI accreditation, and project application and conceptualization and submission and all those things. While on one hand, we will be running training sessions specifically focusing on these two respective topics, there are individuals within the SHRA who are process owners with whom you can interact with even ahead of the sessions and maybe have a discussion specific to your issue or issues. So the first team that I'm going to share the contact details of is the team that is responsible for the project accreditation process. And again, when we do the project accreditation session in a month's time, I'll still come back and share these more details again. So Shilombe Mageza, muting that. Shilombe Mageza is the colleague at the SHRA who is responsible for this process. G.za. Alternatively, you may also speak to Ms. Sanele Maluleka, who's also at shra.org.za. So these are the two colleagues that you may contact with regard to project accreditation, project registration related inquiries, and this may perhaps be able to guide you much more closer and in more detail than we were able to cover in this last 2 days. The other colleague that I'm just about to share the contact details of is Temba Mbangata, Mr. Temba Mbangata, who's with us here. And Temba is Temba M at shra.org.za. So Temba is responsible for your SHI accreditation. So in the event that you and your team are thinking of getting an SHI application in and you want to be guided in terms of what are the templates and what is the process of application and so forth, speak to Temba. In fact, Temba just mentioned to me that, Temba, are you still here? I think they are opening a period within which they will be accepting applications. Temba, if you can hear me, please do just clarify that in terms of when are you up opening for applications and when are you closing, and people so that people can function with you or work with you within this time frame, please.
Okay, thank you, John, for that. I'm still here. Okay, so the application process, we're going through a process of like cycles, and then that means if you apply on this cycle, you have to go through the entire process of being accredited as a social housing institution until the council sits. So that's where it ends. And then now, at the current moment, the next cycle will begin from the 1st of August. From the 1st of August until the 31st of August. I'm not sure if you want me to give you the entire cycle, because after this one, we'll have to go through the other one from
So
November.
that is enough. I think I think people are asking. So if you're opening on the 1st of August, when does it close, so that they know that they can do their submission within this period? When do you anticipate to close this one cycle?
We're not anticipating. We're actually closing on the 31st of August.
Cool.
It's
All
not
right. So you have a whole month, ladies and gents, to then engage with Temba and get in your SHI accreditation applications, which then, as he says, it's within this 3-month cycle. And at a point, you'll then get their feedback in terms of your application, whether it was successful or not. Mandla, let me finish. I see your hand. Let me finish my piece, and then I'll give you, unless if it's specific to what we're addressing now.
You can continue, John. It's
sure
regarding the question that was asked. I wanted
sure
to give clarity on that.
Sure. All right. So those are the contact details. I've also put my email address as well in the event that there is anything else. But in the main, these are the 2 processes that I thought let's share contact details of with yourselves. We will still be sending you a number of handouts. That is the manual I've made note of, the PowerPoint presentation I've made note of, the social housing regulations and the Act. Will also send you that. I think in due course as well, if it's not in the same mail shot that we'll do, it'll be in a separate one. We will also send you a link of this very recording, so that you have a record of this session and the questions that were asked and answers that were given, so that you use that for your own, to refresh your own. I've asked everyone to do the evaluation, and I think that's pretty much that I wanted to share with you. I'm tempted to go to the to other grants, but this is going to take a bit more. I think let me suspend that for now. I wanted to just explain more about other grants. So in the event that you want to know about other grants, support grants that the SHRA has, please use my email and then we can correspond directly, because I was just mindful of the time. Mandla, at this point, maybe then you can come in and close the session. On my side, thank you very much, everyone. It's been a rather productive 2 days, I think. And thank you for